Now that we have a simple model upon which to build, let's start making our projections. The single most important driver of this model is going to be net sales, and what we're going to use is a previous plus growth rate approach. So our formula is going to be equals the previous year's sales times 1 plus, I'm going to use control page up, to find myself to the 5% new net sales growth so that we get a basic $210 million projection, 5% increase over the year previous. For total sales then, we are going to just use a simple addition of the projected sales from our basic operations plus something the case study will add later, new sales from a capital expansion. Cost of sales then, and operating expenses in a bit, we'll use a percent of sales method. So for this, the formula is going to be equals, find your net sales, and we are going to use that number intentionally, multiplied by then, control page up, the 45% assumption of cost of sales as a percent of net sales. Again, then, total cost of sales will be equal to that 94.5 plus any new cost of sales that we have from a capital expansion. Gross profit then will be total sales minus total cost of sales. Operating expenses we will do similar to the cost of sales, meaning that we will take equals this new net sales projection multiplied by then, control page up again, this 35% assumption for operating expenses as a percent of net sales. We are going to have that new OPEX category. So again, we will do a simple subtotal and saying total operating expenses will be equal to those two. For other operating expenses or income, we will again use a percent of sales method. So it's going to be equals to, we find our 210. Actually for this one, let's anchor on the total sales there and multiply it then by this 1% other assumption. EBITDA then will be equal to our gross profit minus any operating expenses minus this other. Now the way we will build the model is depreciation and amortization will be assumptions that are hardwired into the assumptions page. So we're just going to pull them directly into the income statement by making a simple reference. So the formula is going to be equals, control page up. Let's go out and find then this current depreciation expense and just highlight that number. And then, sorry, this is a bit slow. There we go. This 1.5 million and hit enter. The incremental will be the same, equals, control page up. Let's go and find any new depreciation that would occur as a result of a capital expansion. And so total depreciation will just be the 1.5 plus anything new. Amortization, again, will just be a simple reference to that which is on our assumptions page. So that's the 50,000. So now we can add up our total depreciation plus our amortization to get those two numbers, which yields then for us the EBIT line, which will just be equal to EBITDA minus then the total depreciation and amortization. Now, interest expense net will be a little bit of a trickier formula. The way it's going to work, since we will be projecting debt out into the future, also given changes in our possible capital structure, that we're going to want to approximate an average of the ending balance of debt from last year plus the ending balance of debt in the projected year, in this case 2016. Divide that by 2 to get an average balance throughout the course of the year, and then we'll multiply that by the debt rate. So the formula is going to be equals. Use control page down, and we're going to find then last year's long-term debt. We're going to add that then to the projected ending balance for this year's long-term debt, and we're going to go ahead and divide all of that by 2. Now I missed a parenthesis over here, so let's go back and make sure that our formula works right. So we've got then these two things divided by 2 and then multiplied by, control page up twice to get myself to the 10% rate on debt. And right now it's going to show us $900,000. You'll see that's going to change in a bit. But now we'll go ahead and put in our pre-tax income, which is just going to be EBIT, then minus our interest expense. Income taxes will be the taxable income times the tax rate. So equal to pre-tax income multiplied by control page up, find ourselves our 40% tax rate. And then net income is going to be pre-tax income minus income taxes. Hit enter. Once we have all those things done, then let's go ahead and copy everything and paste it across and save it. And if you've done this properly, according to my calculations, the first year's projected net income should be $22,470,000, and the last year's projected net income should be $28,169,000. So let's save that, and let's call that for now the end of our income statement, because we will come back and see it change after we finish our balance sheet.